Welcome to this explainer. Today, we're unpacking the absolute gauntlet that is India's digital payment ecosystem. We're talking about a massive, intricate web processing billions of transactions at literally the speed of light. Now, imagine a giant magnifying glass hovering over this entire landscape, scrutinizing every single transaction, every line of code, and every single business model. That magnifying glass, well, that's the regulatory rulebook, and right now, it is completely dictating who survives and who just outright disappears.
And this intense scrutiny, it's led to a striking paradigm shift. In India today, every payment company is a regulated entity first and a tech company second. Think about that for a second. Before a founder can even think about writing a single line of code, before they design some beautiful app interface or pitch a disruptive feature to investors, they have to survive the rulebook. You're no longer just a scrappy group of coders building a product in a garage. No way. You are a heavily regulated entity operating inside a highly sensitive national financial grid.
So here's our digital clipboard for today. We're going to check off each brutal regulatory hurdle, starting with compliance over code, moving through the PPG escrow mandate, the death of silent subscriptions, data privacy rules, the zero surprise mandate, and finally, how this all leads to market convergence.
Let's jump right into checkpoint number 1, compliance over code.
The fundamental starting point for literally every single fintech strategy meeting today has completely flipped upside down. You know that old Silicon Valley mantra of move fast and break things? Yeah, that simply doesn't fly here anymore. Because if you break things in finance, you break the entire economy. It used to be all about asking, what cool new feature can we invent to disrupt the market? Now, it's strictly, what does the RBI actually allow us to build? The regulator is basically sitting right there at the head of the boardroom table, making the chief legal counsel the most important person in the room.
And this relentless, chronological march of the RBI's compliance engine is something else. The regulator isn't just throwing darts at the wall, right? They are systematically closing every single loophole year by year, essentially turning the entire ecosystem into a high-stakes obstacle course. It wasn't just one new rule, it was this deliberate cascade. In 2020, we get the PAPG guidelines. Then 2021 brought the e-mandate framework. By 2023, the heavy DPDPA Act drops. And now, present day, we're looking at an operational resilience framework. It's just a constant, evolving filter of compliance, demanding absolute adaptability.
Okay, moving right along to checkpoint 2, the PAPG escrow mandate.
So the crucial point here is that the Wild West of holding merchant money ended practically overnight with this specific mandate. Before these 2020 rules for payment aggregators and gateways kicked in, the flow of money could be, well, a little murky. Think of it kind of like a commingled tip jar where company operational cash and merchants' hard-earned sales were just sloshing around together. This mandate forced any company holding merchant funds to get strict licenses and use highly secure escrow accounts. They demanded an absolute mathematically sound bank vault around those funds. This guarantees the merchant gets paid even if the fintech goes totally bankrupt the very next day.
Checking off our next box, we hit checkpoint 3, the death of silent subscriptions.
Now think about your own smartphone and the era of reoccurring payments just kind of sneaking by unnoticed. While the e-mandate framework completely destroyed that era, you can no longer silently bill a user at the end of the month. Those days of set it and forget it auto deductions, completely gone. Step 1 now is that platforms must explicitly alert the user a full 24 hours in advance of any upcoming charge. You know that slightly annoying but absolutely necessary ping you get before your streaming service renews? And step 2, they must require a one-time password for any transaction that crosses a specific financial threshold.
And notice this exact number, 15,000 rupees. At exactly that threshold, the seamless tech experience legally hits a brick wall. It requires an OTP. Now, this is an absolute nightmare for product designers who basically spend their lives trying to build a frictionless, magical app experience. But it's a massive win for your wallet. For any recurring payment above that amount, the seamless auto-deduction is paused, forcing manual intervention. The friction is the entire point here. It forces consumer awareness.
Advancing our digital clipboard, we hit checkpoint 4, data privacy and penalties.
Confronting the reality of handling user data under the laws of 2023 is absolutely no joke. The enactment of the Digital Personal Data Protection Act brought down a heavy hammer on the industry, introducing incredibly strict data privacy laws for the entire country. But what makes this a true survival test is the stringent data localization mandate. What does that actually mean for a tech company in practice? It means they can't just rent out cheap server space halfway across the world anymore. They have to build and maintain physical infrastructure securely within India's borders. When you pair those massive infrastructure costs with company-crushing financial penalties for any missteps,
handling user data suddenly becomes an existential risk.
Let's move to checkpoint 5, the zero surprise mandate.
Take a deliberate pause and just think about that razor-thin margin. The RBI's Operational Resilience Framework mandates that fintechs must keep their failed transactions below 0.5%, just 0.5%. When you consider the complex maze of banks, telecom networks, and servers that a single payment bounces through in mere milliseconds, achieving this requires nothing short of absolute engineering perfection. It's a phenomenally difficult technical feat, and yet this framework makes it a legal requirement just to stay in business. The RBI dictates not just the rules, but the actual technical performance of these platforms.
But you know, the regulator also knows that tech outages are totally inevitable. Servers are going to crash. But the mandate is crystal clear: zero surprise to users. If a server catches fire in Bangalore, the platform can't just go dark. They are legally mandated to have instant, transparent communication during those blackouts so you aren't left staring at a frozen loading wheel wondering if your rent payment just vanished into cyberspace. The communication has to be immediate, transparent, and leave zero room for surprises.
Which builds into the ultimate climax of our explainer, checkpoint 6, the market convergence map.
So this intense, highly regulated environment has essentially left us with two surviving species in the resulting market landscape. You either become a massive horizontal giant, like Razorpay or Pine Labs, owning absolutely everything from the online checkout cart all the way down to the physical point-of-sale terminals and retail stores, or you stand tall as a deep vertical specialist, like JustPay, focusing relentlessly on mastering one highly complex, specific layer, like payment orchestration.
The crucial point here is that this brutal compliance checklist forces a market convergence. It acts as the ultimate evolutionary filter. The sheer cost of compliance is simply too high for the average player now. So we're watching smaller, single-product payment companies get absorbed by the giants. To survive this rulebook, you either need massive scale to afford an army of compliance officers and legal teams, or extreme technical specialization to make yourself utterly indispensable to the big players. In a lot of ways, the rulebook isn't just a hurdle anymore. It's the ultimate moat protecting the giants from new startups. The middle ground? It's vanishing entirely.
So, as we wrap up this explainer, I'll leave you with this provocative thought. In an ecosystem where the cost of compliance is astronomical and the regulatory rulebook is essentially your primary strategy, does the mid-sized, single-product player have any choice but to be swallowed up by the giants or just fade away? Thanks for tuning into this deep dive, and I'll catch you on the next one.